Good morning, everybody. Welcome to Thursday, I think. Is it Thursday today? Morning, Kay.
Good morning, Ryan. Seems like we had a whole week in 2 or 3 hours time this morning.
Whole week, whole year. Central banks all thrown their policy books for the last decade out the window, it seems, all by a couple. Where do we start? Where do we start today? Right, let's get the easy stuff out of the way first. Just a quick run through the calendar. Trade data from Japan out overnight, not looking too healthy. There was a bit, exports are up, imports are up, so signs of increased activity. Didn't do much for the trade balance though. I know this is something that Kay, you're hot on in regards to the Japan and what's going on over there. We're going to talk about the Bank of Japan, obviously, in a bit. The Aussie jobs numbers came out again, looking fairly solid, fairly good. That will keep the RBA on their path at least. Nothing really untoward going on there either. Eurozone, what do we have out this morning? Italian CPI confirmed the jump over last month, there or thereabouts. China, a bit of news out from China, something for commodity currencies at least, Aussie dollar, Kiwi, such and such. They are looking to create a iron ore buying group, as it's called. This is primarily to try and create an institution, if you like, that could be involved in bulk buying of iron ore around the world. They want to invest overseas in overseas mines. This was a headline from the FT, and they plugged it that they want to, take some dominance away from Australia. A bit of spin there, but the general gist is that they want to create something. Their view is that they're fed up with seeing wild swings in the prices. So if they've got a big vehicle to do the purchasing for companies and so on and so forth around the globe, they'll get bulk discounts, or they'll be able to fix prices at better levels, not be susceptible to any big swings. In terms of the currency impact, obviously that's a potential negative for the Aussie dollar if China are going to diversify further away from Australian iron ore. It could mean we see some currency moves potentially in South American countries, if they start to look at producers in different parts of the world, and they start doing big deals over there and big investments. When China wants to throw some money about on the investment front, they tend to go big. So that's just something to bear in mind, keep in mind for commodity currencies there. Right, so let's get straight into the central banks. Start with the ECB and the clown show of their emergency meeting yesterday. We waited for 2 hours, and all we got that they're potentially going to use PEP. They still haven't got a tool, and they're getting their bods to do a rush job on designing one. That wasn't new news. We knew that they were going to be working on a tool, but it seems they're in full panic mode in actually getting a tool in place, and in the meanwhile they're going to use the PEP for it if need be. It's weird because it shows they're more concerned about raising rates than they should be about raising rates, if you get my meaning. All the other banks are now raising rates on the inflation risk. The ECB are putting themselves in the same position, but they're scared of their own shadow, if you like. They want to halt any blowout in yields, and that's the big risk for them, that we do get spreads widening in the yields between, let's call them, the northern states and the southern states, because it always comes down to a question of, in Germany's eyes and others, that they end up paying for the woes of other countries. So it is an issue that they need to address, but they seem to be doing it in such a haphazard, cack-handed way. They're making the situation worse. So that was the ECB. The market didn't do an awful lot, only a bit of flip-flopping about around the 104s, but nothing too huge. Then obviously we had the Fed. Now I don't want to get too deeply into all the after event analysis. You've probably read enough of it and heard enough of it since last night. In the first instance I was wrong. I thought they would stick to 50 BPs. They went 75. They set the path out pretty solidly, 50 or 75 at the next meeting. top rate round about 4%, bringing that back down to somewhere between maybe 2.25 and 2.5%. In a couple of years. So that's basically set the path. As we mentioned yesterday when we were talking about the different permutations, a 75 pip hike and laying the path out, that's what the market was reasonably expecting. So we didn't get too much of a big move. The pullback in that rates would be coming down sent a bit of a dovish slant into the market. We saw the 2-year yields, touching up against prior highs, and I'll just knock the chart up there for you. Let me get onto a decent time frame. So the 2-year yield spiked up there, and I was looking at this while it was happening, thinking, this could be the important part for the news, at least the announcement. If we can't get above those highs, the market is going to give me an indication that it's pretty much priced. Obviously, the move down or the lowering of the dots into 2024 back to a neutral level, that got the 2-year now questioning, where can they get to the high terminal rate of 4%, or is it going to be somewhere a bit low? So I think where we're sitting now, somewhere between 3 and 3.5% is probably about right for the 2 years at the moment. But the fact that we had that move down took a bit of steam out of risk trades, took a bit of steam out of dollar yen. But by and large, looking across most of the currencies and most of the things, we did have some spiky moves, but we're still in the ranges. Well, just seeing that now, we're seeing dollar yen breaking 133. So actually we're getting out of the range. I didn't even notice that. So yeah, this is something we need to keep an eye on now. We're getting a move here, breakout, dollar looking a bit weak. This is into a central bank that is now potentially hiking another 75 pips. It shows the market is probably well priced, and it's looking a bit further forward. Maybe now we're looking a bit more at the Bank of Japan. I just heard of some, they call them light rumors, that there's stories doing around that the Bank of Japan may need to act because everyone else is, and potentially under some pressure or taking a line from the ECB, the IMF meetings about policy coordination. So that's something that's just floating around at the moment, and that could be the reason why we're seeing yen pairs move again. And conversely, that is, potentially going against yield moves. So back to the Fed, we know what they're doing now. So the question becomes, if you want to see yield going high, if you want to see the dollar going higher, it's going to need something more than what we've got. So it's pretty much the same situation as we had when the Feds first started moving to hikes. The market prices, the Fed confirms, then you question, are we going to see any further upside, and what is it going to take to get some upside, further upside there? So for now, although we're seeing weakness here at the moment, other pairs really not doing an awful lot. So, it shows that these moves in dollar yen is pretty much yen led. Cable still a bit all over the shop, but not doing a huge amount. So yeah, we're fully priced now, if you like, for the short term, at least, what the Fed's going to do. Now we're back to watching the data and seeing what goes on. So that's pretty much a quick review of what happened for the Fed. Now we've got the Kate, I'll let you come in, and if you've got any bits and pieces on the Fed.
No, really, but my impression was, and I think the market also traded it that way. The price action was a bit funny over the Fed, right? Okay, they did 75, but then immediately dollar came off because the market sort of got what it wanted, and then saw those planned or the dots were showing cuts in 2024. So first of all, the dollar actually fell a little bit. Then it spiked due to the 75 BPs and still leaving the door open for more. And then we got a slap because it almost felt like a dovish press conference by Powell. Like it looks that he's now part of a kind of a plunge protection team, and saying that yeah, we are going to be data dependent. We're going to see 75 or even 50s are not going to be common, but still we could do some. It seems that or he at least, or they feel the need to start to manage stuff, because they probably know that by doing 75, they'll steer the economy into a hard landing instead of a soft, and they still would like to engineer the soft landing, right? So
Yeah.
we have a bit of a saloon door move on the dollar yesterday, and then this morning we see exactly what we saw over the past Fed meetings, is that on the day itself you have like a yo-yo, even the dollar being more on the defensive than anything else. But then the next day the thing reverses and risks takes a beating, and we are seeing it again today. Yeah, so that about I'm as the people in the room know, I'm a bit short euro dollar. I tried the short cable, but then I tried it again this morning with a little more success. But I'm already out again. I still would like to keep some short euro dollar, but if we want to trade the dollar now, because looking at, for instance, emerging market currencies, we have to wisely pick our dollar pair against something else. If you want to be short dollars, you need to find the other currency which is now trading the stronger, or has the best fundamentals still out there. Could be the best of the week, but as the best fundamentals still out there. And I think the euro is the candidate on the other side, as long as ECB doesn't start to do more emergency meetings, and which I don't rule out, by the way, after yesterday's debacle on the fragmentation tool. So yeah, for the Fed, I would say I'm still in favor of a slightly higher dollar, especially versus euro. But let's remain cautious, and as usual, trade it in and out. Do take partial profits and stuff like that in case something turns around very quickly.
Yeah, I mean, it's for me, it's all about the levels. If we can't or can break levels, that's what you look at. We're potentially setting up for this range between that 103.40 and 105 at the moment.
Yeah, in the short term, I'd say this 105. This was the one that capped right after the rumors of the emergency meeting in the euro, and we couldn't get it there anymore after the FOMC. So I think 105, call it 105, figure 10, figure 15 is about the level, about the right level now to monitor topside.
Yeah, I mean, I actually didn't trade over the Fed. I had my levels set out. None of them came really close. I can be a bit rigid when it comes to things like that. I'll set my points. If I don't get there, I don't trade it. A bit manic, obviously, in between. I know plenty of people in our chat room traded it successfully. There were a few blips along the way from some, such as life. But I think the main thing is, don't be afraid to miss out. We said before the meeting, if you're not sure, don't guess. If you have to sit on your hands, sit on your hands. I'm never scared of missing a trade, because I know there's always one around the corner. So I didn't get really anything I like to trade on. I was looking at that 133 level in dollar yen. So I'm probably a bit lucky that in preparing for the show, I missed that move altogether. But so that's something we'll need to keep an eye on. Now, obviously, moving on from the Fed quickly, we've had the S&B and a real 180, wouldn't you say, Kay? Or probably a 740 or 720.
Yeah, it's you recall what I said when they started on this CPI. Of course, we weren't doing the flow show at that time. I think. But recall what I said when we had this first dump. I said, like, we could be much closer to rate hikes than the market thinks, and then even than what we were prepared for, because all the commentators or the S&B watchers were saying, like, oh, they are going to prepare us for some kind of a surprise intermeeting hike in July. But actually, I said I wouldn't even be surprised if they go now, because the way that Jordan spoke about it and the way that they mentioned about Swiss and stuff already in those days, it made me think that they could go earlier. The thing is, though, that traditionally they would be aligned with the ECB. but now they're moving away from it, and especially Jordan's comments today that they view the Swiss no longer overvalued is a move away from everything that they have been telling us over the past years. The one thing that they keep is that they're going to keep their intervention threat, which they will have to, because otherwise I think Euro Swiss dumps under parity relatively fast. And the other interesting thing is that they say they could intervene both ways. So in my opinion, we are at this 102, which is a bit crucial in my opinion. And we are at this 102, and the top side is 105. So I think if close below 102, I think parity is a question of when rather than if. And I would view the 105 to be a serious top in place right now. If ever we would break 105.5 on this Euro Swiss, it could get ugly on the other side. But in the meantime, I remain a Swiss buyer on dips, which the way we traded, most of us a few of us at least in the room traded this in that way this morning. So we're looking at some nice pips from there. And I'm keeping some shorts in Euro Swiss because I really think it's a matter of time before we see parity, unless again, and therefore we have to always protect our positions unless we get more emergency meetings from the ECB. If we get an emergency meeting from the ECB now, I don't think it's about fragmentation anymore. It will be a rate hike.
Yeah, I agree. And I think perhaps the SNB, because the SNB only have a meeting every quarter, they're potentially getting in front of, let's call, if the ECB say do 2 25 pip hikes, you know, they're getting in front of that because they won't get to act until September now, the SNB. So this could be their front running until then. I can't see them coming out in between a meeting and hiking again. So, you know, yeah, the SNB.
No, I don't. No, I don't think so either. Now, after they're 50 now, I think they are on a path. I think the next one, as you say, is in a quarter's time. So it's going to be. I have the sheet here, 22nd of September. And I wouldn't be surprised if they take rates that above. They do another 50 and we are above 0.
Yeah, I think we might get a little clue on what the ECB do. If the ECB do 50 and indicate 50, then I think you're right. I think the S&B goes again at 50. But if the ECB go 25 and 25 and don't signal a strong intent to keep that going, then perhaps maybe the S&B goes at 25 or holds off. But I'm just waffling. So, you know, if we look at Euro Swiss, as Kay said, we all started hammering the sell button when the announcement came out. Kay got in just above me around the 80s, 90s. I got in at 70s, 102, 70s. We had a nice little ride down. Just looking at the price action now, really, it's going to need to get above this 102, 45, 50 area. That to me it will be a bit of a signal that we've got for the short term potential bottom in place. You can mark the next sort of levels down. You know, we're getting these little steps down in the highs, you know, 20, 30. It's all small stuff at the moment. But we are getting a bit more of a solid looking bottom around about these 60s. You know, is the S&B in smoothing? They won't come in and bid it all the way back up, but they'll just, you know, sit there and pick bits and pieces up, and as we say, we call it smoothing. So, you know, they have dropped a bomb on the market, so I wouldn't be surprised if they were starting to come in down at the lows. Doesn't mean it can't go lower, but if it does go lower, it'll be a slower march rather than a crap out, if you like, if they're sitting there on the bid. And conversely, as Kay mentions, if they are intervening, then keep an eye on other currencies, keep an eye on euro dollar, because as they buy in this one, they can offload in other currencies, and euro dollar is one that they look at as well, to offload some of the buys that they do in the euro. So if we see this going up and dollar and euro dollar going down, that can be an indication that the S&B are there. But you know, we never know for certain, but you can pick up these little clues. But yeah, from here, as I say, it'll take a break back above 102.50. And if we're going to see a downside, it needs to get below these lows. So for the short term, that's our ballpark that we're playing in. If you're moving forward, dollar Swiss, you know, pretty similar situation. You wouldn't think they'd be active in this, would you, Kay?
Well, the thing is, and I'll grab a quick question by Mike. He says, Cayman, why don't you believe that the S&B will stop defending parity? It's not well, parity for one is a big psychological level. You have to imagine that people who have like natural interest in Swiss franc, they would view parity as a big level as well. Bigger players who have like investment portfolios, they will have a look at this parity as well, because it must be comprising their models to have like kind of like alerts if Euro Swiss trades parity. Don't forget that after 2015, this market is for those who were in the market then, the market is still a bit traumatized about this drop sub parity. So I think parity will be quite a big psychological level. Can it go under there? I think so personally, but I would also expect them to come around and try to defend it at least for a while. As Jordan said, they will continue to intervene. So there's, I think, little doubt that they will try at least to hold parity for a while, unless euro completely collapses. I think what they did today is also give them a little bit of leeway, not to paint themselves in too big a corner or in too tight a corner, that in case euro really looks very ugly because the ECB is messing up everything, that they don't have to stand in front of the market and to wear the whole burden of the euro weight. Now, what were you talking about?
Just dollar Swiss, whether they'll be active in that at all, or is it just a consequence?
So, as I've been saying already a few times in the room, the S&B has an intervention system, and they have like a reserve quotum for each currency. They are doing now, which has changed a little bit over the past few years, they are doing equal parts relatively equal parts euro to dollars, and then they do a few other currencies. So what it does until now, since they were monitoring mainly euro Swiss, they would sit on the bid in euro Swiss, and whatever they got in euro Swiss, they would transfer 30 or 35% into dollars of the amount, and then do a bit of other stuff. So whenever they sit on the bid and intervene in euro Swiss, they weigh mechanically on the euro dollar at that time as well. So that about their interventions. Now, with his comments about Swiss not being overvalued so much anymore because it has seen some depreciation, I wonder if they are now not even changing a little bit their monitoring system and rather look at least partially at the dollar Swiss as well, because the dollar is stronger against Swiss franc, where the euro is at its weakest for months and even years. So they might be changing their monitoring system a little bit, which gives them in turn more leeway not to have to intervene in the euro Swiss. So yeah, it's something that we really need to pay attention to going forward in the next months between now and their next S&B meeting.
Yeah, and it you know, it needs pointing out, I think, that in their statement he was talking about in terms of the franc not being highly valued on a trade weighted basis, which is something, you know, and not a lot of people look at. You know, they look at, you know, one pair or two pairs and judge it on that. But perhaps he's got a point that we need to pay a bit more attention to the trade weightings for the Swissy and to see how it's going. But anyway, let's move on from there because we've still got tons to go over. Next up in the hot seat is the Bank of England and whatever clown show they're going to give us. we're expecting, or the wide, medium expectations for the BOE are for a 25 pip hike. The votes are something that are important for this one. We get the vote count, and there's 9 members of the MPC, and the vote is expected to be 9-0 for a rate hike of 25 pips. So the first thing we get is it going to be 25? Is it going to be 50? Again, we're getting that jump up in short-term expectations because of what everyone else is doing, that we may get 50. So again, if we do get a 50, I'm not sure there's going to be a huge reaction in the upside in the pound. Obviously, depending on what notes we get with it. If they go 25, we could get a bit of disappointment in the quid. It's a similar situation to what we had with the Fed, where the bigger price risk is if they don't conform to the market. And if the market's mainly looking at 50 pips, 25 pips ain't going to cut it. But also look at the votes. If it's a closer thing, if they go 50 pips and it's a closer thing, maybe 6-3, 5-4, something like that, that'll be a less than hawkish hike, because it means there's still some members who aren't quite sure about going with that higher hike. That means it could be harder to then follow up with more hikes like that. So there's lots of ways of cutting this one. Unfortunately for trading, you got to look at several different angles. There's no presser with this one, so it's a straight meeting statement and then done and dusted, thankfully, because I don't think I could go through Bailey waffling on for an hour and a half after following all the rest of them this week. So that should be nice and easy. We'll get an idea of what's going on there. Quickly for the quid, what the reaction might be. 120 is probably back in the frame. We had that little, false breakout below, talking about big psychological levels. The 120 is one of those. We're 130, 140 pips away, so we might be too far out the zone. But if we do get a move down there and the news driving it isn't massively a game changer or anything like that, that's the sort of area I'll be keeping an eye on. To the top side, I'm going to be honest, I have no idea. This cable, I'm not in the zone with cable at all. 122 is the obvious level at the moment. Get above there, it can easily run up to 123, maybe 124. But in the wider picture, I don't have a big view on cable at the moment. I'd rather express it through euro sterling. That to me, well, there's obviously less volatility in it, and you get a bit of a chance to get in and out. I got stopped out the balance of my 86 long, the break trade that I tried up here, 85.80. I was hoping to run the rest of it into my core position. But that's where flexibility comes in. I knocked out pretty much on the highs yesterday morning, a chunk of that, plus a bit of my core longs as well. So I put a bit of money in the bank there. But again, I'm a bit more neutral now. Are we going to see another move down to 85s, perhaps, into the 84s, or are we going to get back above 86? It could be that we see a bit of flip-flop action around this level now, where when a level becomes solid, and then we start to see this up and down, up and down, up and down. You've got to really discount the level a bit, or use it more as a pivot point. Are you going to see it holding below? Are you going to see it holding above? But if we get this flip-flop action, then I'm going to widen my range a bit to see where, the possible supports come in. We got some minor supports, 50, 60. That's been an old area as well, 85, 30s. So just in this one, I'm going to see what we're going to do. If the Bank of England is a bit hawkish, then we could get a move down to the low 85s perhaps, and potentially I'll be looking somewhere down 85, 84, 80 to maybe look at a long again, just to see what happens from thereafter, if the ECB are going to come swooping in July with a jump. Right, so the last central bank of the week, thankfully, is the Bank of Japan. So what do you reckon, Kay? Yeah. Put your balls on the line, mate.
Yeah, it's I do think that there's a lot of pressure now on the Bank of Japan. I've been talking about that already in our room and previously. I would really not rule out them to do something. although, as we have seen again overnight, that trade balance, even though exports went up a little bit, and but the imports were still rising massively, and with the levels of energy, commodities, their supply chain problems and stuff like that. This is a really in today's market, should be weighing actually on the yen, and might hold back Kuroda from doing a lot. Anyway, so the overall the overall expectations are that Bank of Japan keep their hands still, but might be starting to talk about some form of doing something. I think, as we have just seen about SNB and stuff that you were saying earlier, Ryan, about like coordinated central bank action. Although Lagarde doesn't seem to have heard, or maybe she missed the call on her mobile. I do think that Bank of Japan might be in for something. At least talk about something that they will do. So there are different options that they have. So the first option, which is still the expectation, is they don't do anything. If they don't do anything, and if Kuroda says no, looking at the trade balance, looking at the low wages, looking at because the real wages are actually still going down. The CPI in Japan is not following the rest of the world, because the Japanese companies are very reluctant all the time to pass through the severe rate hikes that we saw, the severe hikes that we saw via the PPI data. So, and in the meantime, the Japanese government is doing stimulus plan after stimulus plan to sponsor those companies. So there is still this possibility, or let's say even a 50-50, that they keep their hands still, and then I think the yen is really going to get slaughtered. If they don't do anything, or they don't talk about anything at all, I really think the yen is going to get hammered. And then we have to be careful, of course, because if the yen really gets hammered and we trade, let's say we start where we are now, 133 the figure, and all of a sudden we are at I wouldn't even rule it out, right? 138, 139, even 140. Then I think we are running straight into interventions, because that's going to be much too fast for them. But if they don't do anything, that is the risk that they are taking. I really think is the risk that they are taking. So moving on to what the next possibility may be. So the possibilities which they could do are a few. They could start to widen the band of the 10-year JGBs and keep the rest as they are. So perhaps they could go up to a 35 BP band around zero. But the wisest thing, if they do that, would be at least to let the market go to half a percent each side of zero. In the wake of other central banks, right, where the other central banks are much more aggressive. So that would be one thing. The second thing they could do, and it's not exclusive, they can do a combination of course. The second thing they could do is change the maturities. So there's a few people thinking that they could change the maturities and include somewhere the 20-year bonds to maybe loosen the 10 years a little bit, but then include the 20-year. In my opinion, that would have like a counter effect. It would not help the yen at all, because that means that they're controlling the yield curve even further out. So I think, in my opinion, that would have even a negative effect on the yen. The one thing that may start to have a bit of a positive effect is if they shorten the maturities. They let the 10-year go wider. I can't see them really letting the whole thing loose, because then the market the bond market in Japan is going to collapse. But they could shorten the maturities and widen a little bit the 10 years, and then concentrate more on the 5 years, which would steepen the curve a little bit, would give a little bit of air back into the tire, and that I think may have like a stabilizing effect on the yen, rather than really an outright strengthening effect. The next thing they can do is stop intervening in the ETF market and in the REIT market, the rates market, the the construction market. They could lower their interventions there. Of course, it's going to send a bit of a negative signal to their stock markets, but on the other hand, it's going to release a bit of pressure on the Japanese yen. And then, of course, there's the possibility, and again, not exclusive, that they just come up and they say, we are talking about normalization plans, which is not going to be liked too much by the markets either. And I think that could send the dollar yen back to where we were above 135. But if they would really start to what they would call normalize, then I think we could have a visit of dollar yen probably back to 130. And in looking at risk assets which are under pressure right now, we could see yen crosses mostly suffer from it as well. So that is a bit the possibilities that I see of what the Bank of Japan can do. And even though none of the commentators are really expecting them to do anything right now, I would not rule it out. It's the same thing as yesterday I was saying with the Fed. I wouldn't rule out that they do 75. It's the same thing that I will say today for the Bank of England. I wouldn't rule out, even if most expected they do 25. After the Fed, I wouldn't rule out much. They could do 50, but it could be a dovish hike. And Ryan, one thing I was really surprised about is that this vote count is expected 9-0. Last time already they had a 6-3, where the three with
it's 9. Sorry, it's 9. Yeah, it's 9-0 for a hike.
Oh, a hike.
Yeah, not sorry. I don't know. I may not have made that clear. It's 9-0 for a hike.
Okay, not 9-0 for 25, right?
Yeah, not. We'll find out in the statement what the split was for whatever type of hike it was. Okay. So yeah, sorry if I confuse people there. The vote expectation is for a hike of whatever amount. Okay. In the statement, we'll know whether it's 9-0 for a 25 or 9-0 for a 50 or what combination that is. It's a secondary thing to look at after we know what they've actually done. But just quickly back to Japan, the Fed pretty much told us, or Powell pretty much told us, that what swung a 75 pick hike was last Friday's CPI, the 8.6 CPI. So if you're looking at the ECB are turning hawkish, and their inflation's up. The US is going more hawkish because their inflation's up. Mm-hmm. What do you say about Japan and even Switzerland? Switzerland 2.9, Japan 2.5.
But here we get the Bank of Japan will tell you that they are looking at the core, that they're always looking at those import things. They are hoping really to that the supply comes back online, that the energy prices cool off a little bit, that the Japanese government is going to do more packages. So they are hoping, but I really think that Kuroda is underwater, and we can't forget that the Bank of Japan is mainly the governing council of the Bank of Japan is mainly constituted of those, right? Because they couldn't be doing anything else for 2 decades. So it's mainly those, and that's but they are really under an immense amount of pressure. They would never, and also let me remind you that the local banks are under pressure as well from this negative yield environment. They don't have any flexibility whatsoever. So they are now, and they also have a window of opportunity now to normalize a little bit. People are suffering from higher prices, but if the government sponsors the Japanese corporates with stimulus plans to soften that pill a little bit, the blow to the consumer won't be that hard. And maybe that was kind of the message that Kuroda was trying to convey the other day. Because I also read in the press that it might have been a message that's saying like, if the consumer can weather these some higher pressures, that there might have been some hidden message in there that they are ready to start to normalize as well. So
Yeah.
But yeah, I think the CPI being it's above 2%, but the Kuroda has been commenting, non-stop commenting about yeah, but it should be 2% and above for a prolonged period of time.
Sustainable, yeah, sustainable inflation, and wages sustainable as well, and they're still holding back. So you know,
I really think they should. I really think they should start to make a move. It's the same. My opinion about the ECB as well. Our ECB is really messing it up because they have like the best window of opportunity they had in many years, and they seem to be still messing it up. I hope Bank of Japan takes a bit of a lesson from the S&P and does something overnight. If not, and we are just traders. Ours is not the reason why. Ours is to sell and buy. If not, I think if they don't do anything, the yen is going to get slaughtered.
Yeah. So I think, you know, we can, as always, like we did with the Fed, you can cut this thing up 1,000 different ways as to what might happen. You know, we've got to trade it. So what do? I think, yeah, the risk is binary here. This is going to be more of a surprise than the Fed, more of a surprise than the S&B, just for sheer size difference between the Bank of Japan and the S&B. You know, I don't like to gamble when I trade, but I'm seriously thinking about, you know, if we're sub 133, taking a little bit of a long into this one, because if they do stand pat, as you say, this could be back up 135, 138, wherever. The sky's the potential limit for this one. And I just don't know if the Bank of Japan are ready to change just because everyone else is going. You know, they're not the S&B, and I don't mean that sort of in a dismissive way. But if, like you say, if they do act, it's going to be I think it's probably going to be more of a jawbone than actual action. So setting up, and they're not going to set up something huge. They're going to drip feed in a path to starting normalization. I think why that might be the reaction. You know, we see the yen bid. How far will it go? I think that standing still will have a bigger reaction in something like dollar yen than if they indicate that they might want to act. And I might take a bit of a trade on that. It'll be small. I'll have to probably get up to the Bank of Japan tomorrow morning. Looking forward to that. But on the flip side, you know, look at it from the dollar perspective as well. If they don't act and dollar yen rises, are we going to be seeing a lot of sellers coming in just purely from the US dollar side, because that'll push things outside of what we've seen over the FOMC? Do you think there's a case to, you know, give it a day or so to pop, then maybe looking the early part of next week for some shorts?
I don't know. I think that I'm with you on the side of trading. My overall bias is still for a weaker yen. I think unless Bank of Japan really changes tack completely, but my bias is still for a weaker yen. In essence, I still think we are going to see over 140 in the dollar yen, because there will always be huge differences, and the Bank of Japan will always be more dovish than the Fed on the dollar yen. The rest, crosses yen, is more a case of risk and stuff, and it's very, very volatile right now. But I agree with you. I really, what I hope is that they say that they are looking at something. It's driving dollar yen 100 points lower, and then I will counter trade it. Gotcha.
Yeah. So there we go. A couple of ideas there. What to do with the Bank of Japan is going to be another tough one, as we know. So let's have a quick look at some of the other prices, and let us know in the comments, what do you think the Bank of Japan going to do, and you know, let us know how you got on yesterday. Hopefully you made a bundle of pips. Hopefully there's no sob stories out there or bad news stories out there. Let us know what you did and what you think the Bank of Japan are going to do. I'm going to we'll take a quick look at the S&P, because again, this was another one I was looking for what the reaction was, to maybe try and gauge what stocks are actually doing right now. As I mentioned previously, I think that they're going through a period of readjustment from the Fed changing policy, end of QE, QT, that sort of thing. So the reaction here could be a bit telling in what the market is telling us. Is stock still moving on the risk off? Is it moving because the Fed are maybe a bit more hawkish? You know, what's the judgment here? The fact that the wider market, and as Kay said, maybe seeing the slant, the rate hikes coming down in 2024 as a bit dovish, you wouldn't think that in stocks, because you know, you would think in that situation, turning more dovish, stocks would be higher, but there's no QE anymore, so there's no support from the Fed for stocks. So if there's going to be economic pain to come, I think we're further seeing that in stocks, because they're now thinking, right, well, the Fed are going to go to 4% rates. What's that going to do to the economy? Irrespective of whether they cut after, it's going to up to 4% or somewhere around that, 3.5%, 4%. So what is that going to do to the economy? Is this going to be a soft landing or is it not? Now, this is not a huge move we've got here. You know, we had a bigger moves before the Fed, you know, when we coming down from the 41s. So we couldn't get above and hold back above the 38 zone, 38.11. That was somewhere that we were looking at as a potential support when we first got there, and then its resistance. We've got this move south now, so I think stocks are gonna start reflecting what the economy is going to do. If we get strong data, you probably see stocks rise. If we don't, you're going to see stocks fall. So that's what I'm going to be looking for going forward. And it's going to be a bit of an adjustment for people, because you know, the risk on, risk off play is now potentially going back to what it was, you know, 10 years ago, 8 years ago. It's different now. There's no financial support for stocks. There's no QE. Now, no, KS is marker down at 34, what the Fed are watching. We're obviously a bit of a way from that yet. So I'm looking forward actually to hopefully some normality. We can watch the data and you can react in stocks. Good data is going to be potentially a buy, bad data a sell, rather than trying to guess it round the other way. Is it risk on? Is it risk off? That still needs to be borne out, in my opinion. So, you know, what's the next levels that we can be looking at in the S&P? You know, we've got some minor levels down into here, this area around here, you know, the mid 36s, perhaps down into 37. Then we're going to be starting hitting traffic when we get down, you know, around about this area, mid 35s down towards this 50 fib. That could be a big old level down there, because it is potentially where the trend really changes. I mean, you can obviously, I'm talking on a longer term basis, you can obviously see that the trend has changed here, but if you want to take it out, you know, are we at a proper trend change yet? You know, going back, you know, 20 odd years, you know, 15, 20 years. I wouldn't say no. I wouldn't say yes until we start to break this particular period, get below this 50 fib. It's still very much on a long-term basis a bullish market. I haven't got the fib up from down here, the 2019. That'll probably bring the 38. I don't know if you've got it, Kay. I should imagine it brings a, let's put it up and have a look instead of messing around. Let's take it from there to there. Oh, where we go? Yeah. Where we going? I mean, so, you know, the 38.2 of this isn't down until 32, 31. You know, that's a long way away. So this is why I use fibs in the main, just to gauge, you know, is this a real change of trend or is this just noise? Yes, mate?
Yeah, that's my do or die line, as I was saying, I think over Face or so yesterday. So you've got the 3,400 pre-pandemic high, which I think they are monitoring, and the 32 around your area there, the 32, 3180 is my do or die line really.
Yeah,
goes below there, yeah. It's going to look ugly.
Yeah, so it's all about when you're looking at your charts. It's all about, you know, you've got to go through the time frames, look at the bigger picture versus the short term picture. You know, obviously on the short term picture, this move off the all-time highs it's very strong. You know, there's no denying that. It's a huge amount of pips. But take it out to the wider picture and look at your different stages. You know, the 50 fib will be important for this move here in particular. You know, longer term, the 38.2 of this big move from 2009 isn't until the 32s. You know, huge way away still. So in term, you know, match off your short term against your long term, because then like this, you get some confluences developing. You know, this is a big confluence now. It's a 61.8 of this move. So it's the last line in the sand for that, but it's also the 38.2 of the bigger move. Technically, I like things like that. I like long-term confluences of the technicals. Just gives you a bit of greater conviction to have a trade. You know, we can also see its natural support point. It's been a natural resistance point. It's a natural support point. All the things add up. All the reasons to have a trade add up. And if a lot of them are technical, that's great. And if some of them are fundamental, even better. So, you know, in the short term, I think there's still a bit of a shaking out to do here. We need to monitor the data. I don't think we've got any data. Oh, we've got housing starts and building permits today, jobless claims, and the Philly Fed. So there's a bit of data to get stuck into. We know that housing's been relatively weak. You know, the April numbers showed that the main April numbers in the housing showed that what we've been seeing in the NBA had filtered through. The NBA this week was an up week. Whether that's a dead cat bounce or not, I don't know. We'll wait and see. It certainly won't change the trend with one number. So now Powell mentioned that they're potentially seeing softness in the housing market. If that continues, then we start measuring in, is this going to be a soft landing or is it going to be a hard landing? Then you're going to see stocks affected because your home builders are going to be affected. Your mortgage companies are going to be affected. Debt levels are going to start rising. Everything feeds in. And, you know, if stocks start reacting to those negative numbers, we know what the driver is, and then you can trade accordingly. So let's have a quick look at some of the questions that we've got going on here. Yeah, Mike, good point. We do have big OPEX tomorrow, just in case we didn't need any further messes, buckets of buckets of petrol thrown on the fire that we've already got. So huge quarterly expiries tomorrow. You're quite right. So you might need to discount what happens tomorrow. And we're also heading towards month end, which is also quarter end of Q2, and it's half year end. And that can be a bit of a spicy one, but that's a couple of weeks away yet, so we won't get too involved in that.
Yeah, not now, Ryan. Not now.
Anything else?
Ryan. Our head is already exploding.
Sorry, mate?
Not now, please, Ryan, about month end and quarter end. Our head is already exploding.
Yeah, and you lot are going to start getting stuck into what's expected for the OPEX as well. So that's become our new month end. Yeah, it can become a bit of a mess, this month end stuff. We don't like it. I hate it, but it's what we have to deal with. Kay, do you want to look at anything before we shut up shop, any of the metals or anything? Or
no, listen, looking at the time, I'm just going to make a few quick comments. We look at, okay, gold and silver are now starting to suffer a little bit, probably under the weight of risk in general. But it's interesting to look at those if all the rest is really piling in a negative way, collapsing, that those metals could be a little bit of a refuge. Is it how you call it, a refuge in the mountains where you hide when it's snowing too much? A bit of a refuge against all the rest, especially when inflation shoots. Now we had a big drop in dollar versus EM currencies because yesterday after the Fed, the market understood that the 75 was not going to be common, but emerging market central banks will probably respond to this with also 75 BP rate hikes, as Bank of Mexico already has done, and they might repeat. The South African rand strengthened quite a bit as well, and I think there's the numbers in South Africa are slightly better than what people may expect. So if ever there is a cooling down in the yield sphere, I would expect the emerging market to benefit from that, but I'm keeping away from them right now because they're ultra volatile. Dollar mix went down 2.5%, I think, at one stage yesterday, or 2%, 2 full percentage points yesterday, and just rallied 1.5 back this morning. So be a bit careful when you trade that stuff. Adapt your amounts. But for the time being, let's leave it there. We have Bank of England to take care about, and then later on Bank of Japan. I'm done for now.
Yeah, yeah, I know the feeling, mate. Okay, I think there was one question I just wanted to look at there. Anders saying he can't believe 130 puts in UJ for tomorrow cost 32 pips with 45% volume. Are they 32 pips now? We just nicked under 133 still. Might have to have a look at that. That may be a good idea actually, Anders, to look at the options rather than getting into a straight spot trade.
Yeah,
so yeah, thanks for that. I'll have a look at that. I'll pull my colleague's ear, Kay, because he'd be looking at the options as well.
Yeah,
but anyway,
I'm seeing the 132 put is the overnight would be around 45 pips if I'm correct, and the 134 call about similar amount, perhaps a tiny bit more, but the overnight is very much skewed towards the puts, it seems, right now when looking at the option screen. I was looking at the 1 week actually, in case of getting a disappointing Bank of Japan. The 134.5, yeah, 70 pips is a lot. That means that we need to get back above 135 to even start to dream about making money. So it's expensive. It's really expensive.
Yeah. Cool. Okay. Well, no doubt we'll have tons to talk about tomorrow morning if we're all still alive and not knackered and oversleeping. I'm going to set about 8 alarms. I may or may not be up for the Bank of Japan. I'll let the wife decide on that later. But in the meantime, as always, thank you very much for coming to the show. Trade safe, make lots of pips. I want to see you all rich by the end of these shows. And good luck. We shall see you tomorrow. Thank you very much.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.